Good morning, ladies and gentlemen. On behalf of the Hong Kong Monetary Authority, I'm very pleased to welcome you all to join today's event. Climate Risk in Action, a conversation with practitioners. Last November, the HKMA and the International Finance Corporation jointly launched the Alliance to help banks develop the solutions necessary to encourage commercial banks in Asia to adopt strategies and targets to become greener. Today, the Alliance is hosting the third roundtable on climate risk. This roundtable aims to equip participants across the region with basic knowledge related to climate risk and provide a platform for market influencers across banks, financial institutions, insurers, rating agencies, and thought leaders to share their first-hand experiences and intelligence. Today, we're delighted to have Mr. Peter Cashion, Chief Investment Officer and the Global Head of Climate Finance for Financial Institutions Group at the IFC, to deliver opening remarks, followed by a keynote speech by Ms. Pratima Divgi, Regional Director of CDP Hong Kong. After that, there will be a roundtable discussion moderated by Daryl Ho, Executive Director, Banking Policy of the Hong Kong Monetary Authority. Participants are welcome to pose questions for the floor Q&A sessions. To kick off the roundtable, may I invite Peter to deliver the opening remarks. Peter, please.
Good morning and good afternoon to our distinguished guest speakers and audience joining across Asia and the globe. My name is Peter Cashion. I'm the Head of Climate Finance and Chief Investment Officer for the Global Financial Institutions Group at the IFC. It gives me great pleasure to welcome you today to today's webinar on climate risk, a conversation with practitioners, hosted by IFC's Alliance for Green Commercial Banks in partnership with the Hong Kong Monetary Authority. It's the latest event in a series of 3 webinars to address climate risk issues. In this roundtable, panelists will reveal their first-hand experiences and efforts in addressing climate-related risks, as well as upcoming challenges. Now, in terms of some risks and opportunities, there's really a growing awareness of climate risk, and this has galvanized regulators to take action in recent years. Addressing climate risks, together with the capability to measure and disclose, has then become a critical aspect for financial institutions. The Task Force on Climate-Related Financial Disclosure, TCFD, divides climate-related risks into 2 major categories: physical risk and transition risks. Physical risks arise from climate and weather-related events, which can result in financial loss and impaired asset value for financial institutions. For example, the risk of a significant drop in grain yields and damage to capital stock from flooding will double by 2030. And this will increase risks and balance sheet risks. Transition risk stems from the process of transitioning to a low carbon economy. The UN estimates the cost of adapting to climate change could be up to $500 billion per year globally. Disruptive physical impacts will give rise to transition risks and at the same time create new opportunities in the economy. For example, as countries increasingly reduce their dependency on finite fossil fuels, it has also created a new investment opportunity for renewable energy and electric vehicles. July 2021 was the hottest month on record in human history. As temperatures continue to rise, it is imperative for banks to manage both the risks and opportunities effectively. Banks increasingly understand what expectations are being put upon them, but getting there will not be easy. While banks can control their own policies and actions, they have limited control over the actions of their clients. At times, banks have been scrutinized for contributing to climate change by funding fossil fuel projects, although they have been redirecting their activities toward climate-friendly ventures. As one of the largest reserves managers globally, at IFC, we embrace responsible investing by helping banks manage their climate-related physical and transition risk associated with these projects and the businesses that they are funding. We do this by developing a common assessment framework to help banks to assess their individual greenness baseline. We are seeing banks working to develop the data models, analytical tools, and approaches needed to assess their clients' environmental impact. But this is a learning process. They need to step up their efforts to assess how their lending decisions affect their own risks and profitability, in addition to the efforts to assess their clients' contribution to climate risk. Looking at the issue through both lenses help to bring the focus and importance closer to the business agenda of the institution, rather than just viewing it as a regulatory effort. So in closing, I hope that many of you here today will find this discussion useful and insightful. And please stay tuned for the upcoming topics on this events on this topic. Thank you.
Thank you, Peter. Now may I invite Pratima to deliver the keynote speech. Pratima, please.
Good morning, and thank you, Susanna. It is a pleasure to be here and very much appreciate Daryl for the kind invite to speak at this session. The fact that we're gathered here today to discuss on climate-related disclosures, to me, shows how very far we have come since the Paris Agreement, and the numbers speak for themselves. Over 2,000 companies globally today have committed to science-based decarbonization targets. 75% of S&P 500 responds to climate-related frameworks, such as the TCFD, and this is evident from the high reporting rates that we're actually seeing on our own platform. And over 200 multinational organizations are engaging with their suppliers to identify climate challenges and opportunities within their supply chains. All of this corporate action is enthusiastically being met by the financial sector. There is high expectation that the green bond market will hit or exceed $1 trillion by 2022. In some markets, such as Hong Kong and Singapore, which have declared their ambitions to become the green finance centers for Asia and globally, regulators and policymakers have already begun to announce and implement roadmaps and policies to prepare companies for this transition. All this encouraging news, however, comes with two very sobering facts. The first is that despite this momentum in green finance, our data shows that global fund assets, which are aligned to the Paris Agreement, is less than 1% of total assets. The second sobering fact is that the world is going to hit another record high in greenhouse gas emissions in 2021. The question we therefore need to ask ourselves is, how are we seeing the growth of sustainable finance leading to genuine mitigation of climate change and environmental destruction? And this question is important because the answer will influence the success of green and sustainable finance. To strengthen our response to climate challenges, I have identified key areas of priority for the financial sector, noting, of course, that there are obstacles in the path. And to borrow the phrase, we are trying to build this plane as we are flying it. The first and foremost is the conversion of climate information that is easily interpretable into financial impact, negative or positive. We need a list of climate finance ratios, which then help us to develop a common understanding, firstly, of the financial value of a mitigation or adaptation activity. And the second that we need is the benchmarking of these climate ambitions against sector averages and Paris alignment. Some tools exist today to deliver on these. For example, the Partnership for Carbon Accounting Financials, or PCAF, as it is commonly known, which was founded by a group of Dutch financial institutions, has a great starting point on 6 asset classes on the calculation of financed emissions. Another example is the temperature ratings methodology by WWF and my organization, which translates a company's emissions reduction target into a single temperature score, which then allows us to easily see how close or far a reduction target is in line with the Paris goals. These financial ratios are still emerging, and there needs to be a rapid scaling of such tools, methodologies, and standards for the effective growth of green and sustainable finance. It goes without saying that accurate measurement and reporting of portfolio-related emissions will be key to financial decision-making. The second priority should be a need to default to transparency and ensure high accountability in sustainable finance transactions. The growth of sustainable finance will depend on bankable projects that are verifiable. And overwhelming data on sustainability today is voluntary and not necessarily verified or audited by third parties. This, as you can imagine, hugely limits the ability of putting sustainability data to financial use. Mandatory reporting is, of course, of paramount importance, and governments across the world are working on this. But we also need interim solutions as governments support and help companies in the run-up to mandatory reporting. So what could these interim solutions be? As a starting point, financial institutions could start requesting third-party verification of operational emissions for companies in high-impact sectors. On stewardship, financial institutions could consider engaging with their portfolio companies on not just climate resilience, but also decarbonization. As a first port of call, an assessment of how resilient a business's operations are to climate change is needed to assess financial risk. Decarbonization targets are then needed to be built into these resilience assessments. This sounds obvious, of course, but I specifically stress this point because we are seeing companies globally making net zero announcements without first conducting a full risk evaluation under climate-related financial disclosure frameworks, or they're focusing purely on risk mitigation without considering the opportunities that will come with low carbon transition. Monitoring of climate strategies of these investments will help companies adopt the right approaches to transition. On the point of decarbonization, uncertainties currently exist. The first is, of course, our collective need to arrive at pricing ranges for emissions and a treatment of emissions during a company's transition to net zero. Presently, there is no standard way to measure, report, and verify carbon removal. And in the absence of such standards, financial institutions could perhaps begin engaging with their investments to see if they have internal carbon pricing policies in place and how carbon pricing models are being implemented in their business operations. For example, our database shows approximately 800 companies in Asia today actively considering internal carbon pricing strategies or intending to do so in the next 2 years. Data points such as these will provide strong guidance to financial institutions on how companies are assessing climate transition and considering mitigation measures. And finally, it is well acknowledged today that climate change is a systemic, undiversifiable risk. From this perspective, an urgent priority for us today is to shift our mindset that green and sustainable finance is a separate asset class. We will not be able to mitigate the worst impacts of climate change by segmenting sustainable finance as an opportunistic investment strategy. For us to collectively meet our goals of the Paris Agreement, all finance needs to be sustainable. Thank you.
Susanna, good morning, everyone. Let's move on to the panel discussion session today. Peter and Pratima actually mentioned a few times that the importance of addressing climate challenge, and this is one of the most pressing challenges facing the world today. And in recent years, we have seen increasing frequency and intensity of extreme weather events, including flooding and wildfires. In Hong Kong, for those audience that based in Hong Kong, you actually has just experienced the hottest September with an average temperature of 29.7 degrees Celsius. And there were actually 15 very hot days and 11 very hot nights in the month, both marking new records for September in Hong Kong. To address these extreme weather events arising from climate change, we need substantial reduction in greenhouse gas emissions. Otherwise, global warming will exceed 1.5 and even 2 degrees Celsius during the 21st century. Now, the roundtable today comes at the perfect timing. The COP26 reminds us that the financial sector can make significant contribution to addressing climate change. You remember that the Paris Agreement aims to make financial flows consistent with a pathway towards low greenhouse gas emission and climate resilient development. And one of the key emphases of COP26 is also to mobilize climate finance to drive the transition of the real economy towards net zero by 2050. But the key question is how? What sort of tools are needed to help financial firms to deliver these goals? One example is taxonomy. Taxonomy plays an important role in help driving financial flows towards green activities. How shall financial firms manage multiple taxonomies across different parts of the world and use these activity-based classification systems to facilitate their lending decisions or asset allocation decisions, which are often entity-based? And where are the gaps and how to address those gaps, including the data gaps? For instance, in Hong Kong, financial regulators will mandate financial firms as well as listed companies to make TCFD disclosure before 2025. Is it enough to create the data needed for addressing climate risk and managing climate risk by the financial firms? Financial regulators in Hong Kong are already working very hard together to address these challenges, trying to build a green ecosystem here. We strive to develop a green bond market by building a large green government bond program, as well as covering part of the cost of a green certification faced by green bond issuer. We also working closely with universities and organizations such as the IFC to beef up our effort on the capacity building. And we are also in the process of building some common utilities to facilitate climate risk management of financial firms. Obviously, greening the financial system requires collective efforts on all parts of the green ecosystem, and market participants can play a critical role here. Today, we have an excellent panel which comprises experts from different parts of the financial world, and they will share the insights in the climate risk management, related opportunities, and also challenges during the green finance journey. So please join me welcome our panel today. Today we have Mr. Victor Cook from Swiss Re. The Swiss Re Group is one of the world's leading reinsurers, insurance and other forms of insurance-backed risk transfer. And Victor is the head of climate markets for property and casualty, basically non-life reinsurance business in Southeast Asia, India, Korea, Hong Kong, Taiwan as well. Victor is a risk expert, has extensive experience in the insurance industry. Our second panelist is Mr. Wai-Shin Chen from the HSBC. HSBC Global Research is a leading research house with a strong focus in emerging markets and extensive coverage of ESG factors. Wai-Shin is an expert in ESG research. He's now the head of Climate Change Center of Excellence, leading HSBC's global ESG research team. And last but not least, we have Ms. Juliet Macreasy from VE, which is part of the Moody's ESG Solutions. The VG, part of the Moody's corporations, it serves the growing global demand for ESG and climate insights. The group's offerings includes ESG scores, climate data, sustainability ratings, and sustainable finance certifier. Juliet is the executive director of the Asia business. And without further ado, let's start our panel discussion today. The first question that I have is actually for Victor. Victor, you are coming from the reinsurance world, and obviously, on the asset side of the balance sheet of your company, you also need to manage your portfolio. Could you share with us, the Swiss Re strategy in managing climate risk in the investment portfolio?
Yeah, sure. Thanks, Daryl, and happy to be here, and also happy to have a panel discussion with Juliet and Wei Xing. So, like I said, Swiss Re is a reinsurance company. So we are also a risk knowledge company. So we look at a range of risks. So climate risk is one of them. And at our company, we normally associate climate risk with natural catastrophe. So things like typhoon, flooding, as the world kind of become warmer, these are the things that we looked at. And because that's part of our business to protect our clients. In our company, we have a sustainability ambitions. So by 2030, we have 3 things that we want to focus on. So climate risk is one of them. And also it looks at energy transition in terms of how we manage the whole flow. The second will be societal resilience. And then the third thing is on kind of how do we make affordable insurance using digital platforms. So these are the topics all linked together. Now, when you talk about, how do we manage the risk in our investment portfolio? So we do have a kind of sustainability framework. So if you look at some of the commitments that we have done in the past, so 2017, we have embedded what we call ESG criteria in our investment strategy. So how do we sort of look at those according to the criteria we set? And then 2019, we kind of moved to Net Zero Asset Owner Alliance. So this is the one that we looked at. How do we get to a carbon neutral investment portfolio by 2050? And then the third thing, which is more recent, is 2021, where we kind of co-founded Net Zero Insurance Alliance. And this is the piece from a kind of a reinsurance industry. We look at the underwriting portfolios, get to a kind of a net zero greenhouse neutral by 2050. So a lot of things we do is targeting 2030 to 2050. Now, when you look at investment portfolio, so we do a kind of systematic approach. So we've got a 3-pillar approach. How do we incorporate it in our decision makings every day? So the first thing is enhancement. Second thing is inclusion. And then the third thing you can probably tell is exclusion. So you include and exclude. So enhancement is really about how we sort of, again, looking at the ESG criteria, looking at our strategic asset allocations, the investment portfolio, which ones sort of kind of qualified to be in it. So now we have 100% of our decisions is based on the enhancement criteria where you incorporate the ESG. So that's kind of a day-to-day things for us already. Inclusion is really about, how do we look at some of the pro-climate net zero investment. So there's quite a lot of those in the market these days. You probably heard about renewable energy, solar panels is some of those, and now it's become renewable infrastructure setup. So we look at those setup, and then we will look at the investment according to what they do. And then the third piece is relatively straightforward, is how do we exclude some of the stuff? I think the hot topics on, coal-fire, fossil fuel, is something that we progressively look at. How do we sort of control our exposures or investment in these areas, right? So for example, we exclude the 10 most sort of carbon intensive industry in our investment portfolio. So we're doing quite a few things. But that's all part of the sustainability ambitions that we're trying to get to by 2030.
Thanks very much, Victor. Let me turn to Wai Shin. At COP26, over 450 financial firms pledged to align their assets to net zero. How could they achieve this? And what challenges lie ahead? Is it even possible, that they can actually achieve net zero by that time?
Thank you, Daryl, for the question. Yes, it is. It is quite challenging. We have to think about the different aspects of the entire industry. I mean, different parts to consider include the underwriting, the insurance, reinsurance, lending, banking, asset management, capital markets, retail, and more. And some are easier to do than others, absolutely. But I want to give maybe 5 points, if I may. The first has definitely got to be awareness and understanding. This might sound quite basic, but it's very important to understand what are we dealing with. It's not just extreme events, but it's also slow onset events. It's not just the transition, but it's the economic impact that it will have. So a true understanding of the filtration of these climate risks, both the physical and the transition that Peter mentioned earlier, and how that can filter through to the economy at large. Next, we have to think about both our own operations. So what are we doing internally? I think we have to get our own house in order first for all financial institutions, and thinking about which sectors can we focus on, where can we have the biggest impact, so to speak, and how can we accelerate that transition quickly. And then we use that knowledge and understanding to help our clients in the different areas that they operate. So that is quite important there. One further step would be to setting goals. I think setting goals and actually changing the policies to make that happen. So we talked a lot about sort of the net zero alliances. HSBC is a founding member of the Net Zero Banking Alliance, and we have a target of 750 billion to 1 trillion of sustainable financing towards net zero transition by 2030. So setting goals is important. How we meet those goals is also important. So we need to be mobilizing the capital. How can we do that? How can we help our clients? How can we use our internal assets to do that? That is very important, because we need to embed de-risking instruments into that. It's very challenging to ask people to invest in something that they may not know enough about, or which carries potentially more risk. And so we have to work with our partners, whether it's regulators, other agencies, other peers, to work on how we can de-risk these instruments. At the same time, I think we can't forget the adaptation side of things. It's not enough just to be focusing on the transition risks and how we can decarbonize our economy, but we also have to help our clients prepare for the impacts of climate change, and that is the extreme weather events as well as the slow onset events. So in Southeast Asia, we have a lot of coastal regions, for example, so sea level rises, land degradation. And finally, the challenges you ask. I always get asked this question, Daryl, thank you for that. The lack of information, as Pratima already mentioned, that is very, very challenging. It's the disclosure that we need to improve on. It's great to have potential initial disclosures from TCFD, as been discussed in this panel, but we need to think about what is the quality of that. Are they consistent? Are they coherent? And a question I always like to ask, or tell my clients to ask of their companies, are the carbon disclosures a true and accurate reflection of the climate change risks faced by the company? Because they may not be. And what we have to avoid is greenwashing. Thank you, Daryl.
Thanks, Wai Shin. Obviously, the financial firms themselves may not necessarily equip, with all the necessary tools, for them to addressing the challenges. And also from the perspective of investors, you also should legitimately worry about, greenwashing, what can we do about it? And that actually comes to the question, are there any service providers in the market actually would help us to help the financial firm, in addressing these challenges? And Juliet, it's time for you to share with us, some of the services that, people like yourself can provide to the market. How financial firms can leverage on things like, for example, ESG ratings, in facilitating their credit allocation decisions. How can they do it, on this front? And how can you explain a bit about the forward-looking nature in those ESG rating, and how investors can actually make use of the information contained in those ratings?
Yes, thanks a lot for your question. So it's as you pointed out, and it was mentioned by the speaker's note as well, the financial institution started to integrate ESG and climate risk into their risk assessment process. This is really important, especially for high transition sectors where the cost of carbon transition can be really high. It can be, involve higher costs of, and it can as well change the debt profile of the corporate, as well for issuers in operating in area with high physical risk. They could be really have negative impact on their current operating business. So how we can serve and support our organization, finance institution on that. Exposure to climate risk are already taken into account in our ESG and climate risk profile via different scoring, which has carbon footprint score, energy transition score, physical risk score. This is all help us to understand how it will impact at the end the credit profile of the companies. To do that, we need, as we mentioned, we need to be able to understand from the granular information to get the right overall view on the creditworthiness of the companies. So we start always with the more granular information to understand what are the company are really facing in terms of transition risk and physical risk. So for transition risk, we will request information on, the GHG emission of the company, their involvement in fossil fuel. For physical risk, we'll ask more about, the concentrations of the facilities of the companies in flooding area or water stress or typhoon areas. And as well, we'll ask more about their climate governance, what we call the climate governance. So have they read it in terms of disclosure about their alignment to TCFD disclosure, but as well different taxonomy. So by capturing this information, it will already give us an idea on how they are facing, what they are facing in terms of physical risk and transition risk, and how it could impact their credit profile. Then we can assess the second step, which is how a change in climate policy could impact the company. For example, a change in carbon tax. What will be the cost for a company to retrofit some activities? And are they, all their facilities concentrated in one specific area? And we've got the example of the Thailand flooding in 2011, that really impacted the profile of companies, the financial profile of the company. So when this second step of analysis is done, we can integrate that in our more overall assessment about the impact of those risks to the creditworthiness of the company. And at the end, the question we want to answer is that, is the company able to fund its transitions in the business toward a more, less polluting or greener business operation? One of the other quick questions that is really important for the financial community to answer, it's more about the probability, the liability that the company could face because of climate issues. And I'll just take the example of PG&E, which is the first climate bankruptcy, we call it like this, linked to the California wildfire. This company became bankrupt because of the liability due to the wildfire. So this is really key. And then this is all this information that we capture, and we try to capture at the best we can, given and I will come back on that, given the data issues that we take into account in our ratings today. Then I will come to your question about forward-looking opinion. So forward-looking opinion is a step further where we do analysis not only on identification, the risk, but as well stress testing and analysis. So what does it mean for financial institutions? It means that they will have to probably adjust their credit rating and as well project the creditworthiness of the company based on different climate scenarios. So to do that, we try to support our clients with two types of variables. The first one are the climate variables, and the second one are macro financial variables. And both of them have to be combined to create these climate risk scenarios. of course, when we always start with the regulatory parameters, because you need to start somewhere with common backgrounds. So if we do look a little bit at the climate risk variable we provide, there's two aspects in that. The first one is identification of the climate risk, and the second one is quantify them, how we can quantify and measure them. So I already mentioned some of solutions to identify these climate issues. I spoke about the physical risk data scoring, which is forward-looking data on the organization on specific hazards. There's as well the transition risk data, which is an assessment on the company ability to reduce its fossil fuels and to leverage on other power energy and other technology. And then the climate governance. The climate governance is more about how the company is able to discuss about this alignment to climate regulatory issues, but is the company already forward-looking in terms of taking opportunities from this climate change? So this is really on the identification of the climate risk issues, and then the second part is more on quantification of them. So I mentioned the climate macroeconomy scenarios that we do provide with an 80 years horizon, and where we align our assumption with the NGFS, so the Network for Greening Financials system. So we use the same assumption that they are using for physical risk and transition risk. We do also as well provide climate adjusted probability of default for listed companies and unlisted company. And then we have some software and model to translate climate pathway scenarios into variables, into financial data that can financial institutions use in their model liability or asset allocation. So this is a kind of solution that can be tailor-made actually, but they're all based on the same methodology to support financial organizations and corporates.
Right. Thank you for the explanation. I think basically, what you need to do is to really understand the business models of the firms, really well, and to look into the exposure to the different types of climate risk, and try to quantify them, and impose certain kind of scenarios and risk stress testing, on the firms, and then you distill all the information and come up to the ratings, to facilitate the decisions of financial firms. So obviously, there are actually high degree of uncertainty in the assumptions that we make, in those stress testings or scenario analysis. Obviously, that relies on the expert judgment of scientists, for example, and also the expert judgment of economists about, how the climate transition can impact the macroeconomy, so on and so forth. So there is always an element of, uncertainty in the analysis when we come to, stress testing these firms. But when we come to the financial firms themselves, can I ask you a follow-up questions on that? The financial firms are also asked to conduct a similar scenario analysis and stress testing, which is actually quite different from firms that are in a particular business, for example, power generation. So how does it differ from a typical stress test or scenario analysis conducted on a normal business in the case of a financial firm? Can you give us some tips about how to conduct this sort of analysis?
Yeah, so maybe in terms of user case of all this, because at the end, this is the point, how the financial institution can use these data and support that. I will say that just to take a step back, the key data which we do provide on physical risk, for example, is it's be able to quantify and dimensions risk into scores. So we provide scores that on specific hazards, so flood, hurricane, typhoon, wildfire, water stress, and so on. And then we provide a score based on the frequency, severity, and exposure in the different regions. We just recently released a new data set that is as well weighted by populations in all regions and for this specific hazard. So how lenders or banks can use that? They can really assess their portfolios and properties by location and by hazard. And then they can integrate this data into their own models. Because at the end, you're right, financial institution needs climate models, and they need climate models with a kind of homogeneous hypothesis. So they can use it for, I don't know, their risk department. They can use it for their capital provisioning. They can use it for IFRS 9 disclosure. So, but they need a solid one at the beginning with the same parameters that are consistent from whatever they disclose to whatever they do projection on their clients. I'll just take a really quick example on a solution we provided for a large banking group who asked our assistants, to develop and conduct stress testing on their mortgage portfolio in Hong Kong. And so the solution we provided was a mix of, implementation of climate risk adjustment into their credit risk departments, but as well physical risk scoring and data by location and by hazard in their different banks facilities. And we add the climate scenarios, for 40 years in this case, and to be able, to drive these different scenarios. And of course, it was based, because it was Hong Kong, so it was based on HKMA narratives and regulation requirements. So this is a kind of solution we can provide to financial institutions to help them, to support them really in being able to be compliant with the regulations. And I mentioned earlier what we call the climate governance, which is a new name, but to just to encompass all the solutions to support that. And this coming from the TCFD alignment, the EU taxonomy, but as well green share assessment or climate controversies. And this is really showing the diversity of our physical risk or transition risk can affect a lot of different departments and different way of doing business, actually. So yeah, I'll probably stop there, but I really think it's important to put in perspective these solutions and making sure that it's always improving and as well evolving as well, because we've got new solution and new technology every day that need to be taken into account.
Thank you for the further sharing. Wai Shin, can I come back to you again on the role of banks? I think, when we just heard earlier on, when Victor shared about, how Swiss Re, is managing its portfolio, embedding the ESG factors in the decisions. He mentioned exclusion, that, for some of the really high emission industries, they or certain, types of industry that does not satisfy the green criteria, they may actually consider to exclude them. But, the outcome of having the banks, excluding all the brown industry could be devastating. If you can't do it in one go. So any advice to our banking colleagues, among the audience, what should they do to assist these industries to transition to a net zero target?
Thank you, Daryl. Yes, indeed, you can't do it immediately. We wouldn't have an orderly transition in that sense. I mean, the first thing I would say is actually have those conversations. I'm always somewhat surprised that climate is not in every banking conversation that relationship managers have with their clients. It should be a part of this discussion. It should permeate the thinking and the strategic direction. So that's very, very important. Then it would be a case, especially for these brand companies, as you mentioned, Daryl, of nudging and advising. Sort of, thank you for your thoughts to the client, but what about considering this? Have we considered this climate scenario or this emission scenario, as was mentioned by Juliet? How can we embed this into your thinking when we need to provide you with capital solutions? The third thing is often mentioned on this panel is scrutinizing the strategies of these companies. That's very important. Are they science-based, as you mentioned? Are they soundly net zero? Do they actually have a vision? And is there a management incentive to actually raise that ambition? Or is it just greenwashing? To be honest with you, we have to cut through the greenwashing and think about how ambitious these targets are. brown companies definitely have the potential to transition towards green and greener companies in the future? Do they have the vision and the management ability and goal to actually do that? That is very, very important. I think one thing that we have to look at is not the immediacy of it, but the momentum. So are these companies making progress on their climate vision, on their transition, on their targets and goals? And are we seeing that disclosed in an appropriate way? If they are making momentum, I think that's fair. The next question to ask is, how quickly are they making this progress? If year after year we're asking the same questions and there's no progress, we'll have to sort of rethink the relationships there. And then it is up to maybe financial institutions to give some form of incentive and engagement. That can be in a variety of different ways. There is discussion about lowering the interest on loans, for example, or giving the sustainability linked aspect of it, giving more incentives should they meet certain sustainability targets. And maybe it's a better rating from Juliet and her team, for example. So how can we give those incentives? But in the end, after all said and done, if there's no momentum, if there's no progress, if there's no incentive, then we have to make some quite tough decisions. But that's a long process. It's not something that happens immediately. So hopefully it's well thought out, and hopefully it's something that we give our customers and clients enough time to prepare for.
Well, obviously, the whole banking community has to work together to assist their clients, in this greening journey that moving towards the net zero. They can't come back to you and say that, oh, you don't want to bank with me, I bank with the other bank, So everyone would have to have the same target in order to create an effect. Now, allow me to go back to you, Victor. Earlier on, I picked your brain, on the investment side. Can I ask you to say a few words, on the underwriting side? Obviously, the insurers are really the experts of quantifying risk and price the risk. And, in the area of physical risk, for example, it is actually quite in line with the catastrophe risk that the insurers are looking at. And transition risk, of course, is another, animal that we need to deal with. But for the other parts of the financial community, they are not really that well equipped, in addressing those risks. Are there any experience that you can share with our audience on that front?
Yeah, sure. So there are quite a few things there. So maybe I'll just touch on the underwriting and then the solutions. So earlier, talk about, nat cat and climate change or climate risk for us is kind of tend to lump together. That's partly because it's what we do. So maybe I'll give you a couple of figures. So 2019, economic loss from nat cat events was around 146 billion. So quite big figures. Insurer loss was 60 billion. So you probably start the question, okay, so where is the balance of that? Where did they go? So someone has paid for it. I don't know who, but not the insurance industry. Now, 2020, the two numbers, one of them has increased to 190. And then the other one is 90. So you can tell that the numbers in terms of economic loss arising from cat events, whether it's climate change related or not, is there, is increasing. Insured loss is also increasing, but there's a gap. Yeah. So that tells you if you sort of get the underwriting wrong, it's a very expensive business. So what we do on the underwriting side, I think Julia explained quite a lot on the modeling piece already. So one piece we do is kind of an in-house cat model. So we're looking at all the different trends of the climate change and then embed it into the model. So that's one thing, we do on a regular basis, and that's we share with our clients as well in terms of what the model tells us in terms of the potential loss and the return period. And then the second thing is how do you kind of prevent it? Now, prevent it, there are a couple of components, right? So first thing is we have a business sustainability risk framework. So we look at the type of risk, we identify them, ESG and climate risk, everything together. And then we look at ways of mitigating them. And in some cases, if we can eliminate them, that would be the outcome of that, the framework that we do. So that's one thing. And then the second one will be on the solutions that we can offer. So at the end of the day, reinsurance company is all about, so how do we help insurance companies as well as the community? So there are a number of different type of solutions that we currently offer to address this. So one of them is quite popular, is called index insurance. I think commonly known as parametric solutions as well. So this is a relatively straightforward, not indemnity product, but it's looking at the severity of the cat events, whether it's the amount of rainfall, the flooding, and tied to the claims payment. So it's relatively quick in terms of settlement. So it helps the people to get back to their lives a lot quicker, and also to speed up the entire processing piece. So we do that quite a bit in Southeast Asia with some of the countries where they suffer event already. The other one, again, Juliet talked quite a bit on that, is the analytics. So how do you use all this data? What does it tell you? And then we provide those data to help the cedents, in our case, insurance companies or other, or for example, bank as well. So what does it tell you about the potential loss that you might see arising from some of these events? And then the third type of solutions is mainly geared towards the government side. So we call it public sector solutions, because insurance company and governments tend to look at the needs quite differently, right? So governments, you look at public assets, you look at government assets. Are they protected, for example? So we design solutions for them as well. And then the last one is kind of popular in Hong Kong lately, is basically insurance-linked securities. So Hong Kong has launched that a few months ago. So this is basically cat bonds. Basically, how do you solve? It's a vehicle you transfer the natural catastrophe exposure in climate change into capital markets. So Swiss Re is a kind of a pioneer. We've done that many years ago, and we do that quite regularly, advising governments, World Bank or ADB, to help some of the developed countries to kind of manage that. So there's a couple of things that we do, and hopefully some of them can help the banks in terms of what you do. Now, your last question was more on for example, HSBC, if you don't have those data or the know-how, what do you do in managing those, right? So I say these days is through data. Data is kind of everywhere these days. You have a lot of data that I don't have, and I have a lot of data you don't have. So simple solution is work together. We can come up with partnerships, and we do that quite a bit. And the partnership could be in the form of how do we design a product to manage the exposures. Best would be using a digital platform because that's kind of the popular thing to do these days. So we do that quite a bit with not just banks, with other reinsurance company, data company, because a lot of things these days you can measure things with sensory technology as well, right? So for example, rainfall, agricultural type business, looking at rainfall, how do you design solutions to prevent them? So I guess my answer to that would be look at how we can sort of help each other to come up with solutions to help.
Gather the data and to become data scientists in order to address the issue.
Yeah.
Now I know we are running out of time, but there are a few questions from the floor, submitted by the audience, but I think I'll just pick one and just to seek a quick feedback from each one of you. So maybe you can respond by one or two sentences. And I think this is a quite relevant one because when talking about all the green finance goals, they all sounds very good, very that's the right thing to do, etc. But how can we ensure there's no greenwashing? So can you share with us, in one or two sentences, what you wish to see? There are certain arrangements that can actually help us addressing greenwashing. Wai Chin.
Thank you. Spoken about greenwashing a lot. I think the disclosure and the verification of that information is very important. One of the things that was discussed at COP26 was the overall mitigation of global emissions, OMGE. It's does this strategy or does this activity truly result in a reduction of emissions globally, and the emissions are not leaked or transferred elsewhere? So how can we get the assurance and the verification from the companies that their activities are doing it properly and are not, to be honest with you, just a marketing campaign. So the scrutiny needs to be there, and the scrutiny comes from the regulators, the service providers, the investors, and civil society and the general public. So all of us need to work together, as Victor says, in partnership to try and see how accurate these climate disclosures are and whether they present the risks going forward and how they can transition towards lower carbon.
Victor, what you wish to see, if on addressing greenwashing, as an investor, is what you wish to see on the front?
What do I wish to see? So for our business, I think the ESG topic is kind of embedded, right? So if I just look at the last 3 months, the number of engagements we have regulators in entire Asia, for example, sustainability topic is on top. So whether it's about framework, policy, and what do we do, right? So what we'd like to see, I think, is continue to see that, if some of the regulation comes through and embedded into requirements for how you manage your business would be the best way of managing it. But it would take some time. I think some of the kind of the more developing countries would take a bit longer to get there. But I think ultimately, I would say the regulations would be the good starting point.
Yeah. Juliet?
Yeah, I will say that, okay, green entry, it's a big topic and there's a different way. So our role as data provider and service provider is really to bring data and transparency to avoid this greenwashing. So it's our key roles, I will say, but to do that, we need quality underlying data and we need to have transparency. So one of the points is not how you define, the good ESG measures or the good ESG methodology, is to be transparent on your methodology. So stakeholders can really understand what is going beyond this number and what does it mean. And I will say quickly, the second key point for me is to start with a short-term commitment. It's great all our companies, all as a corporate and all the, we've got a flurry of, a long-term commitment on net zero deep decarbonizations, which is great. But to arrive at and to avoid this, what's happening in these 30 years or 40 years, we need short-term goals. And then for me, the short-term goals that each company should be transparent or it's really the best way to demonstrate their commitment and their willingness to act today, to start today their ESG journey or their transitions. So this short-term goal for me is as much important as the long-term commitment we're seeing.
Yeah, excellent. I just noticed that, after, hearing the views from each of you on this topic, I noticed that we do have a mini green finance ecosystem on the stage today, ranging from regulator, investor, insurer, banks, and the service provider. And I think that is important, to address this, we can't really do it alone, and we need to work together to collaborate, to share the data, and also to, share, the analytical tools available in addressing that. And climate-related risks obviously are affecting all sectors of a financial ecosystem. And it's important that we actually share those insights in addressing the challenge. And also there are actually new opportunities arising, in the financial world, obviously, to finance transition in particular. There's a huge financing needs arising, from transition, and that actually represents, a good opportunity for the banks and for the investors to take part in the transition process. Now, let me thank the excellent panelists, for today's discussion. And I think, we do have a very meaningful exchange here today. And I hope, that sort of conversation can continue. Thank you again.
Thank you, Daryl. Thank you, everyone, for joining the Climate Risk in Action, a conversation with practitioners today. We hope you all find today's roundtable insightful. There will be an email sent to each of you with a feedback form. Your suggestion will be carefully considered and highly valuable for us to plan the future events of the Alliance. Thank you and have a good day.